All right, everyone. Investors are dropping out of the housing market left and right. Wall Street has officially abandoned the U.S. housing market because a new data fresh off the presses from Redfin is showing, get this, folks, a massive 49% year-over-year decline in investor purchases in the first quarter of 2023. You could see that this drop of 49%, it's the biggest in U.S. history in annual terms, even bigger than the decline that happened in 2008 during the last housing crash. And I've been warning you guys about this collapse in investor purchases for the last year, starting a year ago, because now with mortgage and interest rates surging and with home prices on the decline, it simply does not make sense for investors, particularly big Wall Street investors, to buy real estate. And in certain cities, these investor declines have been especially severe. One of these such cities is Phoenix, everyone. Take a look at this. According to data from Redfin, 2,600 investors purchased in Phoenix in the first quarter of 2023. Take a look at this, 2,600. That's lower than the amount in 2015, and it's about 65% lower than the previous peak that occurred just about a year ago in 2022. And if we go further into this Redfin data so you can see other cities where these investors are bailing, you see Atlanta down 66%, Charlotte down 66%, Denver down 50%, Vegas down 60%, Nashville down 60%. It's left and right, folks. Sacramento down 50%. These investors aren't buying. And this is a massive shift in the housing market, which is a tremendous win for the regular home buyer who watches my channel. You guys have been waiting for a better time to buy, and these investors bailing from the market is a good step in that direction. While you might not see yet in your city the price that you want or the inventory you want, the good news is that you are now stealing back share from these investors because, like I said before, it does not make sense for them to buy. And let me show you the data on why these Wall Street investors are having such big issues right now, folks. If we take a look at the data, all we really need to do is look at two key data points, everyone. Number one is the cap rate that investors are buying at. Cap rate is basically the profit that investors get from buying real estate. You can see that, around 2015 it was 6%, today it's 4.6%. But really what matters is the cap rate relative to the mortgage rate, the orange line. And why investors were buying from 2015 to 2022 is because the cap rate, their profit, was above the mortgage rate, their cost of debt. So that meant that they were getting basically free money by buying a house. Why not buy a house when your unlevered return was higher than your cost of debt? It was a no-brainer. But then starting in April 2022, take a look at this, folks. Something interesting started to happen. The mortgage rates went up due to the Fed rate hikes. And it was in April of 2022 where the orange line crossed the green line, which meant all of a sudden it wasn't profitable for investors to buy. And now we're in the situation in May 2023 where the mortgage rate's 6.9%, or I should say June 2023, 6.9%, while the cap rate's 4.6%, which means that investors are losing money if they buy in today's housing market, if they buy with debt. And what you got to understand is that most investors do buy with debt. The notion that all these Wall Street buyers make cash offers is a flawed one because the source of that cash is almost always some type of credit facility or mortgage-backed security where the interest rate is roughly corresponding to what the 30-year fixed mortgage rate is for regular home buyers. So, these investors, they're having real big issues right now, which is why their purchases are down so much. And to just really solidify this in your guys' minds so you can understand this, I'm going to show you a listing that I found on Zillow. And this listing really shows you the issues that investors are having. It's from a big corporate investor, this listing. And you can see, pay attention to this, everyone. This listing is on the market for $2,200 a month in Phoenix. Now, this investor bought this house for $440,000 in 2021 during the peak of the bubble. And then they originally listed it for rent for $2,350. Now they've cut the rent to $2,200. So that's bad to begin with. The investors are having to cut the rent in Phoenix, so they're earning less money. But really the big problem here is the pro forma. When I do the pro forma for this property, look at what this property is earning. At $2,200 a month in rent, if they rent it out, that's $25,000 a year in gross income, $7,000 in expenses, which comes to $18,000 in net income, which is a 4% cap rate. Remember that cap rate we talked about before? 4% cap rate at their original purchase price of $440,000. This is an investor called Roofstock who's bought a lot of homes in the U.S. housing market over the last couple of years. So 4%. That's not very good, everyone, because right now, anyone watching this video could go and buy a certificate of deposit for 5.1% right now, which would be higher than the return that the investor is getting on owning this property in Phoenix. So that means that the opportunity cost of buying real estate in a city like Phoenix or the other ones I'm going to talk about in this video is negative. The opportunity cost is negative because it's better in terms of return to buy short-term bonds or CDs. However, folks, the bigger issue is, again, that these real estate investors use mortgage debt to buy these properties. And so not only is the opportunity cost of owning real estate at a 4% cap rate negative, that 4% cap rate is before the investor has to pay interest on the debt. So imagine that Roofstock all of a sudden, were to try to sell this property to a new investor. Would the new investor want to buy this property? Well, no, they wouldn't. And here's why. Because if the new investor were to buy it at $440,000 using an 80% loan at a 6.9% mortgage rate, that would be $2,000 a month in interest, $24,000 a year, meaning that the investor would actually be losing $7,000 a year on this property if they bought it in today's market at today's interest rates. And so that really shows you just how far we are from real estate making sense as an investment in a lot of different housing markets in America. We really need two things to occur simultaneously to bring the investors back in. Number one is prices need to go down by a lot more to make the math make sense. And then number two, mortgage rates need to come down. And mortgage rates have been problematic for the U.S. housing market for both investors and regular home buyers over the last month because they've shot back up to that 7% range, which is just creating huge affordability constraints for the regular buyer and especially the investor. And, I think the next stage of this investor crash in the housing market is going to be not only are they going to stop buying, but they're going to start selling. That's really like the next phase of this because the investors really haven't started to sell yet. This is the one part of my prediction that hasn't really come true yet, is that I thought a year ago the investors would wise up and start selling, but they haven't done that. And again, the reason they haven't is because it's just going to be so problematic. Like on this example I gave you in Phoenix with this property that Roofstock owns, if an investor were to come in and buy it, they would need to probably buy it for like $360,000 or $320,000 to start earning a profit. So that would be like a 30% haircut that Roofstock would have to take on the purchase. And they just don't want to do that right now because there's still this idea among many investors and people in finance and homeowners that things are going to get better into the future. We're seeing the stock market rally. We're seeing the unemployment rate, which went up a little bit today, still be very low. And we're seeing more and more of this idea that we're going to have no landing in the economy. And so with a more bullish sentiment that's going on, people aren't going to be in a rush to sell, even if fundamentally they should sell based off the numbers, even if people are maybe even losing money on their investment property after paying their lender, they're going to float it for the time being because they think in the future, 6 to 12 months, Powell's going to cut rates, things will get better, prices and rents are going to go up, and then it'll be worth waiting. But really, the thing that's going to need to change to kind of cause the forced selling is problems in the labor market. The unemployment rate specifically is going to have to start going up and going up meaningfully before we see the investor fire sale, before we see a lot of maybe homeowners be forced to sell their second and third home for liquidity reasons. And I do think that surge in unemployment and the problems in the labor market are coming because when I look at certain cities, everyone, and I go to what I call my recession risk dashboard. On my recession risk dashboard, I look at the unemployment rate in different metro areas going back 30 years. And in this case, I'm looking at Miami. And in Miami, what do we have right now? Well, we have a 2.3% unemployment rate, which is near a record low. And that's causing like a lot of investors in Miami who have stopped buying to not want to sell because they say, hey, look, at least strong economy, it's going to grow in the future. But what do you notice in Miami, folks, and some other cities I'm going to show you in a second? Well, in recessions like in 1992, the unemployment rate went to 9.4%. Or in 2010, it went to 11%. And on average, in recessions in Miami, the unemployment rate goes to 8.2. So we would expect, and we should expect, this unemployment rate in Miami to go up a lot over the next couple of years. Even if you're someone who's more bullish on the economy, you would say, okay, this isn't going to last, given the historical averages, which will create a lot more unemployed people, a lot more forced selling, and home price declines in Miami. Another market that's like this is Riverside, California. I mean, take a look at this, everyone. In Riverside, the unemployment rate is currently 4.2%. It's gone up a bit in the last couple months, but still pretty low. But historically, take a look at what happens to Riverside in recessions. In 2010, the unemployment rate in Riverside went to 15%. In 1992, it went to 11%. In 2003, it went to 7%. So on average, the unemployment rate in Riverside goes to 10%, and it's 4.3% right now. So what does that mean about the future of inventory and selling and prices in Riverside's housing market? I'm going to guess it's going to mean we're going to see more inventory and more forced selling. Also in a market like LA, folks. People forget that LA is a super volatile economy. Unemployment rate today is 4.7%. It was 10% in 1992 in that recession, 6.6% in 03, 12% in 2010. So on average in LA, the unemployment rate goes up to 9% in recessions. And so what's the point of this exercise? It's to tell you guys as a home buyer or potential investor out there to not be maybe deceived into thinking that there's no way that inventory is going to go up in the future. There's no way that there's going to be forced selling, because very clearly there will be. And all it's going to take is the labor market to get worse, which it will, because we're at a historical low point in unemployment, and that's not going to last. Now, going back to my point here about investors for a second, folks, there's a lot of people out there who say to themselves, okay, I see that investors have stopped buying at the end of 2022 and early 2023, but they say, well, that's not going to last. Like the investors are going to start buying again. I did a tweet thread on this a couple days ago, and a lot of people in the comments said the investors are just waiting to buy and that they're sitting on all this cash. It's one of the biggest narratives I see about the investor situation, is that people think there's just gobs and gobs of capital waiting to be invested into the market. And one reason they think this is that because if we look at historical capital raised by Wall Street investors, which is what these bars show, in the single-family mortgage-backed security market, what do you see? Well, in 2021, investors raised $17 billion in mortgage-backed securities and debt to go buy homes. $17 billion in 2021. It was a lot. It was a record. Then they raised $11 billion in 2022, and that came after $9 billion in 2020. But then take a look at 2023, everyone. In 2023, these big corporate Wall Street investors, the Progress Residentials of the world, they have only raised $600 million so far in 2023, which is granted it's only 5 months, but you can see this is going to be on pace for easily a record low. And so what this is showing is that not only are investors less inclined to buy, do they not want to buy as much, they actually don't have the capital to buy, $600 million. So once they get rid of this maybe excess capital they raised during the pandemic and buy some more homes, they're going to run out of money. And then at that point, they're going to have to sell their existing portfolio to finance the new acquisitions. And so ultimately, I see a lot of issues for these investors where I think in the long term, I think it's over. I think the investor domination of the U.S. housing market's over. Maybe you'll see some reports here and there of some groups buying some homes, maybe from builders or other investors. But by and large, I don't think we're going to see that investor demand ever return to the levels it was during the pandemic. Because, another thing to just look at, if we go back to this data from Redfin, look at different markets like in Phoenix, right? We saw the big collapse in Phoenix. But what about just some other markets here? Nashville. Redfin's showing that investors bought 673 homes in Nashville in the first quarter of 2023. That was the lowest level of investor demand since 2014. I mean, that's absolutely crazy, everyone. The investors are out on Nashville. What about a market like Atlanta? in Atlanta, they bought 3,000 homes in the first quarter of 2021. That's about 60% below what it was before in 2021, and it's even lower than the levels before the pandemic in 2017 and 2018. What about in a market like Las Vegas? Let's look at these investor purchases in Vegas. 1,300 homes purchased in the first quarter of 2023. That's way less than before the pandemic in 2017. So, what about Charlotte? Actually, folks, you guys see Charlotte. Charlotte's probably the biggest drop of them all. Went from 4,400 homes in 2021 to 1,100 homes in early 2023. And so if we change this to looking at the share of purchases in the market, you can see investors bought 18% of the homes in Charlotte in first quarter of 2023 compared to 34% in 2021. So what this means, folks, is that regular home buyers are gaining back the market share in Charlotte, which is great news. Of course, what is interesting is that investor purchases didn't decline everywhere. They mainly declined in those hot Sunbelt housing markets that everyone raved about over the last couple of years, whether it be Phoenix or Vegas or Tampa or Nashville, those markets. The investor purchases declined, but they actually gained market share in some surprising markets, particularly in California. Look at this, everyone. If we go to Anaheim, we can see investors purchased 23% of the homes in the first quarter of 2023. That's actually an all-time high in Anaheim, which is super interesting and unfortunate. What about San Diego? In San Diego, investors purchased 22% of the homes, also an all-time high. And then in an interesting market like in Cleveland, in the Midwest, investors purchased 24% of the homes in the first quarter of 2023. And so actually Cleveland went from being a market where only like 7 to 8% of the homes are purchased by investors to 24%. And so what's going on here? I think in the markets where investor market share increased, like Cleveland and Anaheim, it's much more of like a local investor presence there. And the smaller local investors, I think, are still buying in some cases. And so in those localized investor markets, the investor demand is holding up better. Whereas in those big Wall Street institutional markets like a Phoenix or Atlanta, the Wall Street buyers have dropped out, which is why the investor purchases have gone down so much in those areas. And like I said earlier, I think this is a trend that's going to continue. And if you folks want more information on this data, and you want to really get a grasp on the investor purchases and what's happening in the housing market, I would encourage you guys to check out the Reventure app blog. I know a lot of you have signed up for Reventure app and have used the application, but I'm now doing daily blog posts on the Reventure app blog, and I actually first covered this topic a couple days ago along with other economic topics. So I'm going to have a link to the Reventure app blog in the description. Make sure to check it out and make sure to become a subscriber so you can stay up to date when I post on the blog. Because there's some really interesting trends going on in the housing market right now. And to be clear, I don't want to be overly cynical for investors. I know if you are an investor, it's a tough time for you based on all this data. But I do want to say that there are certain cities in America that I think if you are an investor who is insistent on buying in 2023, like say you're someone who's just like, I have money in the bank and I don't want to keep it in the bank, and I want to put it somewhere. I think there are certain cities that you can do that and feel safer. And those type of cities would be higher cap rate cities where you can buy an investment property and from day one get a higher cash flow return that's above the, let's just say the 1-year treasury yield. It would be above the mortgage rate. And the good thing is, if you go to Reventure app, and check this out, folks. If you go to Reventure app, you can click and see, and you can actually go to premium data points and select cap rate and see markets organized by cap rates and see the ones where you get the highest returns. Particularly these ones in red. Certain markets in Alabama, cap rates are close to 8.9%. Now, I know not everyone wants to buy in Alabama, but in general, these markets in red have higher returns for investors, whereas the markets in blue have lower returns for investors. And it's these markets in blue that I think are going to really struggle over the long term in the housing market because, in San Francisco, the cap rate's 2.7%. I mean, who's going to buy for 2.7% return in San Francisco? Additionally, if you go to a market like Austin, the cap rate's 2.9%. It just doesn't make sense to buy as an investor in a lot of these markets. And one cool thing you can actually do with Reventure app is you can use some filters to figure out maybe what markets would be safe to buy in. So let's just say maybe markets that are at most 25% overvalued. Let's filter anything that's more than 25% overvalued out. So we're left with markets that are less overvalued. And let's maybe say, okay, on top of that, we want to look at markets where the cap rate is above, let's just say, 5%. So we're not dealing with any super low cap rate markets. Okay, there you go. You now have a list of certain markets that are, let's just say, more insulated from a downturn, and you can add other filters to this if you want. And really start to get a list of what might make sense to you if you're an investor or someone who's just looking to move and figure out a new market to buy. So Reventure app gives you all of that capability. I would encourage you guys to really use this tool to validate what you're doing as a home buyer or an investor. And now we have a comment here in the chat. Matt is saying, so many people renting out single-family homes lost money in 2020 due to COVID-related eviction moratoriums. The risk for long-term rentals went way up. Apartment complexes are much safer. It's an interesting comment. What Matt is saying is that all those government mandates and rules about evictions and foreclosures during the pandemic hurt a lot of investors, specifically in California, where in California, I think in LA, only in the last couple of months, are landlords now allowed to evict. And so his argument is it's better to buy like a big apartment building, or maybe not even a big apartment building, one with like 20 units as opposed to just a house with one renter, because it gives you more of a diversified experience and your cash flow isn't as concentrated with one renter, which makes sense. Moving back to Reventure app, folks, some other cool things you might want to look at. Say you're not an investor. Say you're someone who just wants to understand as a home buyer, buying versus renting. Does it make sense to buy or rent? We can look at that data as well and look at something I call the buy versus rent calculator, where on this map, we're looking at the cities ranked on what's the difference between buying and renting. So for instance, randomly in Augusta, Georgia, I just clicked on it. The typical house payment for a home buyer is $1,350 a month, while the typical apartment rent is $1,350 a month as well. So in Augusta, it costs roughly the same for you as a home buyer versus what your rent would be, which means actually I think in Augusta we could still see decent home buyer demand going forward. However, take a look at a market like Denver. In Denver, the typical house payment's $3,600 a month versus apartment rent of $2,000 a month. So it's 75% more expensive to buy in Denver. And if we look at this over time, we can see that it wasn't always this way. Well, a couple years ago in Denver, it was only a couple percent more expensive to buy. Now it's 75% more expensive to buy. And so this means a market like Denver, I think, is unlikely to see kind of a return in home buyer demand so long as it's way more expensive to buy than rent. What incentive do home buyers have in Denver to get back into the market? Similar in Salt Lake City. In Salt Lake City, it's 92% more expensive to buy than rent. Typical house payment of $3,300 a month compared to $1,700 a month apartment rent. Again, what incentive do home buyers or investors have to come back into the Salt Lake market when 2 years ago in Salt Lake, you were only paying 12% more to buy compared to rent? And ultimately, it's that buy versus rent calculation, which is the biggest driver, I think, for the average first-time home buyer. They're looking at a property on Zillow, they're calculating how much they would have to pay, mortgage interest and taxes and insurance, versus what they're paying now. And I think, we're seeing record low home buyer demand right now. Mortgage applications to buy a house are still near the lowest levels of all time. And that's not going to change so long as this buy versus rent dynamic is super out of whack. We have another question here from the chat. Someone's asking, does the cap rate calculation include rent and taxes? And so if we go back to Reventure app here and look at cap rate, the question is, does it include rent and taxes? And the answer is yes. So if you look in Atlanta, we're saying that the net rent income is $21,000 a month here on Reventure app. That does include deductions for property taxes, which are the actual taxes, insurance, as well as some assumptions for other costs. And so, this cap rate data includes the property tax data, which is other interesting data to look at. If you go to property tax rate, and you could see, the markets with the highest tax rates and the lowest tax rates. I know a lot of you want to be in these lower tax rate markets, which is, again, another thing that you could filter on. if we go to filters, do property tax rate, and say, I don't want to be in a place with tax rates higher than 1%. Well, there you go. Now you have a list of all of the metros in America with low property taxes. Maybe these would be some markets to look at. Of course, maybe you want to be in a market that's not too overvalued as well. And so these would be low property tax rate markets that aren't too overvalued, maybe some places to look. And ultimately, everyone, my mission here at ReVenture Consulting is to help you guys as home buyers and real estate investors make a better decision. And so if you haven't checked out ReVenture app and the ReVenture app blog, I would really encourage you to do it. There's lots of great data on all the data points we talked about today. And this thing with the investors, I think it's a bad sign for the housing market in the future. So long as investors are out, that's a huge demand source that's not coming back. And I think as we see more forced selling, you're going to see more inventory and more price cuts on the market. So until next time, this is Nick from ReVenture Consulting signing off. Make sure to check out the data on ReVenture app.